For sure. Okay. Let us move on. Aaron reviewed Disney. I think we're going to have Brett, or is it Brennan? Brennan. I think
Doesn't
Brennan's
matter.
gonna, whatever you guys want. Deere. We might as well do our your stock, our take. Let's have Brennan do
Okay.
Deere and Co.
We could have rock, paper, scissors for it.
Pre-show.
Yeah.
Or live. Live is better,
Live,
probably.
yeah. Rochambeau.
Do
Okay,
one right
so
now. See, just
no,
do
no, no.
one. Come on.
I've already shared my screen. So yes, this question comes in from one of our clients, Daniel. So thank you, Daniel, for this question on Deere and Co. or DE on the New York Stock Exchange, currently trading at a price of about $510 per share, about $140 billion market cap, and a dividend yield of about 1.26%. They engage in the manufacture and distribution of various equipment worldwide. The company operates through 4 different segments: production and precision agriculture, small agriculture and turf, construction and forestry, and as well as financial services. Now, the stock has performed very well since pre-pandemic, up over 210% since before the 2020 drop, and this was led by a significant inflection in net income, where they were growing EPS or earnings per share with a compound annual growth rate of about 15% from 2015 to 2019, but they actually increased this to 20% from 2019 to 2024. So we saw an inflection over the last 5 years. Now, looking at the most recent quarter for Q2 of 2025, ended April 27th, 2025, revenue declined 16% to 12.8 billion. Looking at the individual segments, production and precision ag businesses revenue was down 21%, primarily due to lower shipment volumes, with operating profit down 30%. Small ag and turf revenue was down 6%, again, as a result of lower shipment volumes, but operating income was actually up 1% due to lower production costs, lower warranty expenses, and price realization. Construction and forestry revenue declined 23% due to, again, lower shipment volumes, and operating income was down 43% in that segment. And financial services net income was down about 1%, but it remains a small piece of the business. Um, Now, the company updated its guidance, which it previously provided in February, its fiscal year 2025 guidance, decreasing the bottom end of its previous range and its net income range of 5 to 5.5 billion, and they've now decreased that low or that bottom end from or to 4.75 billion, but maintaining that top end of 5.5 billion, which at roughly the midpoint would be a decline of about 21% from fiscal year 2025. And this equates to a forward price to earnings multiple of about 26 times. And if we look at the median price to earnings multiple over the past decade, the stock had typically traded or has typically traded at about 16 or 17 times trailing GAAP earnings or accounting earnings. Now, looking at each segment, they are expecting each industry and segments revenue to be, down or flat. And looking at the segments, they're looking at each segment revenue to be down about 15 to 20% roughly. And management's indicating that increased interest rates and tariff impacts are leading to shifting market demand. So at this point, to sum up this slide at least, the company is certainly facing headwinds, and compared to its historical multiple, it is trading at a premium at this point. Now, looking at the balance sheet, it remains quite levered with a trailing net debt to EBITDA multiple of 6.1 times, but we can see that the company's share count continues to decline, which is positive for EPS and is why we have actually seen EPS decline at a slower rate than net income in the last few quarters. Looking at some operational updates, the company acquired Centera last Friday on May 23rd, a company with industry-leading cameras, which are compatible with most major drone platforms that enable farmers and crop scouts to quickly and efficiently capture high-resolution data at scale. They also announced in April that it was investing $13.5 million to expand its remanufacturing facility in Missouri. And both of these, are just essentially part of the company's continued investment in its smart industrial strategy, highlighting a planned $20 billion investment in the US over the next decade for product development, technology, and manufacturing. So, to conclude here, near term headwinds are facing the business, with revenues of all segments expected to be down this year, as well as net income is going to decline compared to 2024. The company has a good track record of producing mid teens EPS growth, but did increase it to about 20% from 2019 to 2024, which was positive for the business and why they were demanding a higher multiple. Uh, the balance sheet is quite levered with a trailing net debt to EBITDA multiple of greater than 6 times. So I do think that it is a bit on the higher side and something to keep a watch on. And the company is certainly facing headwinds. And compared to its historical multiple, it is trading at a premium at this point. So again, at this point, I would be a bit hesitant to build a position in the stock and believe it is closer to fair value, in my opinion. I don't think that it's a bad business, great brand name. They have grown their dividend at a 5-year growth rate of 15% with a payout ratio of just under 30%. This could increase as earnings may decline in fiscal year 2025. But again, earnings growth has been good. The business has been buying back shares and has, a smart industrial roadmap for continued investment. But again, I just think I'd be hesitant entering the stock at this point in time with elevated multiples and these headwinds in fiscal year 2025. And here is the disclosure.
Yeah, you got elevated multiples, headwinds, and it's a good long-term business, but in the near term, the market should know that earnings are coming down, revenues are flattening to coming down. So, I would look for a better entry point if you like
Yeah.
Deere long term.
And I'm really surprised that like the stock price, hasn't really, had a major pullback, just with the headwinds and tariffs. And like from my understanding, they do have manufacturing in several countries, including Canada. I believe that they've got a facility in Langley. But a majority of manufacturing, again, from my understanding, is in the US.
Yeah.
So again, that's something to keep in mind.